Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. We are living through uncertain times in the financial markets for many reasons. Joining me to discuss geopolitics, the U.S. national election, and market impact is Stuart Katz, CEO and CIO at Robertson Wealth Management. Stuart, it's great to have you with us. Welcome to Trade Talks.
Thank you for the opportunity to be with you.
Let's start with geopolitics and your thoughts on U.S. and China relations. Do you expect further deterioration there?
We do. However, I think it's important to put this in the context of two heavyweight fighters. And early in the boxing match, fighters sometimes feel each other out. And currently, the U.S. and China are throwing punches at each other, in essence, to score political points at home. And while the current trend is deeply concerning, what we are discussing with our clients are really three or four key points. First, the phase one trade deal is still in discussion and there's still room for progress. Second, we're talking about the real prize here. And the real prize is intellectual property, it's technology. And we are monitoring China's positioning vis-a-vis Taiwan in regards to a potential pivot to something that would be further deterioration. And then thirdly, China's playing the long game here. China wants access to the global capital markets for long-term growth. And so as much as they're going to be throwing punches along the way, we think that their eye is on the prize in terms of wanting really to stay integrated with the capital markets for the long run. And so our portfolios are barbelled in the US and international markets with an emphasis on China.
Well, Stuart, the 2020 national election will certainly prove to be a pivotal time for the country. What are some market scenarios you are looking at with a Trump versus a Biden win?
The presidential election is one of many uncertainties facing investors in the near term. And we always think about in constructing our portfolios near term, long term. But as it relates to this election, there are two perspectives I would like to highlight for all of us on the call. First, it relates to market performance and a desire to lean on history. And when you think about history, history would tell you that between now and the election in November, that we should expect a fairly tight trading range. And then subsequent to the election, whether it be a Democrat or Republican, that the market will likely appreciate, although modestly. The second dimension around market performance relates to an incumbent or a new president. And on average, over long periods of time, the stock market goes up by about 10% a year. And if there is an incumbent reelected in that year, usually the market performs around 13%. And if it's a new president, the market would typically trade up around 9%. So think carefully in terms of near term, long term. Recognize that in the near term, the market can go up or down. It's a 50-50 toss of the coin. But over the long term, the markets generally go up in excess of 80% probability when you think about measuring it over years, not over days or quarters.
That's an
the
excellent
other
point.
dimension around the presidential election, I just want to highlight, relates to taxes. And people are expecting taxes to go up. There's a lot of stimulus spend. That's fine. But keep in mind, when Obama was reelected, the market went up over 30% during his second term when he proposed taxes. And for Biden to be able to get his tax policies through, you'll need the White House, you'll need control of Congress, you'll need to influence moderate Democrats. So what you expect and what ultimately is real can be two very different things.
Outside of the financial markets, what other longer term considerations are you watching?
We're focusing on demographics. Here in the US, over 10,000 people a day are turning 65 and they're in need of yield in a yield-starved environment. Deglobalization, index construction, we've all heard about and have talked about the concentration that exists within the indices, labor costs, populism, social unrest, healthcare innovation. There are a lot of trends that are happening, and the COVID crisis is accelerating those trends. And so the markets are really pulling forward a lot of key issues and challenges that will exist whether or not we have a Republican or Democrat in the office.
Yeah, that's a good point. So in terms of the markets, do you think 2020 will be defined by winners and losers? And we're seeing that now. Where are the divergences?
So it's an excellent question. And one of our first principles is rigorous manager selection, incorporating active management into portfolio construction because of exactly what you're just asking, winners versus losers. The COVID catalyst is accelerating a divergence between those categories. Two examples. One relates to, first, quality businesses with quality balance sheets. If you have durable revenue streams and you're offering a service and a product that is relevant to consumers and businesses today with a balance sheet that is fortress-like, that is not excess leverage, you're a winner. But despite all the Fed liquidity that's being placed into the market, it's not an antidote for solvency. If you have a bad balance sheet, the Fed can't solve that. The capital markets can't solve that. You have a bad business, it won't be solved. So they will continue to be in the loser category. The other key element in terms of winners and losers is what we describe as digital infrastructure. Digital infrastructure, impacts the real estate industry. Think about 5G. Think about data centers and vertical real estate that we call cell towers. Those are going to be winning property types that go beyond the traditional property types that you would have considered in the past, office as an example.
Let's go back to the stimulus package for a minute. And you touched on this when we were talking about taxes, but realistically, there's a massive debt that's going to have to be repaid. What's that scenario look like?
Some things are easy to say and hard to answer, and that's certainly an incredibly important question and one that we're discussing with our clients frequently. We are in a new regime. The Fed and the fiscal policies are more closely coordinated now than we've seen in a very long time. And the three primary ways that you pay for all of this stimulus are: one, taxes, and we anticipate that they will go up; two, growth, and maybe there'll be an offset with all of this stimulus to help with growth, and maybe there'll be some more infrastructure spending on green projects or other types of initiatives. And then the third way to repay for all of this debt is inflation. And while we don't anticipate inflation in the near term, it could lead to rising expectations in the medium term. There are no longer budget hawks in Congress. You have a strong financial banking system, which in the great financial crisis was on its knees and could not be a transmission mechanism to help extend credit. You have direct funding, so-called helicopter money into consumers. This is a setup for potentially inflation that we have not seen before. Again, it's not our base case in terms of any spikes in the medium term, but that's really what we're thinking about and concerned about in our conversations with clients.
All right, Stuart, and to wrap here, how are you advising clients? Because you have to think about positioning your portfolio to generate returns and also protect capital.
The key building blocks in any portfolio are in cash, equities, and fixed income. And the Fed is anchored cash basically at 0%. The Fed is basically anchoring fixed income on a risk-free basis for 10 years at 60 basis points. Put a credit spread on that, that's maybe 2%. So equities on a relative basis, we believe, are more attractive to those other alternatives. However, it's going to be a bumpy ride, and our expectations for equity returns are more muted than the historic long-term trend. As a result, we think clients need to rethink the traditional 60-40 portfolio. Take that 40% that was normally in fixed income, wanting it to provide yield, wanting it to provide a buffer in the event of market drawdowns, and think about reallocating some of that to a more durable alternative asset class, multifamily. It has characteristics and attributes that we think are not a perfect substitute, but incorporated as part of a financial plan can help you achieve your near-term and long-term goals.
All right, Stuart, appreciate all the insight. Thanks for joining me on Trade Talks.
It's really my pleasure. Take care.
Thank you, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.